Imagine this. A newly listed company just couldn't wait until the end of the year. Investors were literally in a panic, demanding answers right now. But when the financial year hasn't even ended, how on earth does a company legally show the market its performance?
Ever get completely confused looking at quarterly profits? Well, our founder Aarav's brand new company had just hit the stock market, and every single quarter, investors were hounding him. They were asking, what's the profit, and are we actually growing or not? But we all know that final audited accounts are only prepared at the very end of the year. So how does Aarav report his mid-year performance with absolute legality and accuracy without breaking any rules and without crashing his stock? It's a massive problem.
Section 1, AS-25 to the rescue. To survive this, Aarav really needs to understand Accounting Standard 25, Interim Financial Reporting.
First things first, what exactly is an interim period? Well, it's simply a fraction of the financial year. For most companies, this means reporting quarterly, so every 3 months, or half-yearly, every 6 months. You can think of every interim report as a mini financial statement. It acts like a quick pulse check on the company's health right in the middle of the year.
So what does AS-25 say actually goes into this interim report? You don't need to build a massive, exhaustive annual report. Instead, you need a condensed balance sheet, a condensed P&L, a condensed cash flow statement, and selected explanatory notes. It doesn't need every single granular detail, but it absolutely must have enough information for investors to make solid decisions.
Moving to Section 2, the Golden Core Rule on Measurement and Recognition. And honestly, this is the absolute most important rule of the whole standard.
Aarav, listen up. You cannot use different rules for interim reporting. An enterprise must apply the exact same accounting policies in its interim statements as it does in its annual ones. Just because you're reporting for 3 months doesn't mean you get to magically change the fundamental rules of accounting.
Basically, quarterly reports change the timing, not the rules. If the company had a terrible month, you can't just randomly defer expenses to future months just to smooth out your earnings. Any kind of artificial smoothing or manipulation during interim periods is strictly, absolutely not allowed.
Section 3, Seasons, Taxes, and Expenses. Let's look at Aarav's real-world trials.
What about seasonal businesses? Like if a company sells ice cream in the summer, naturally their sales are going to skyrocket in that specific quarter. But can you evenly spread that seasonal income over the whole year just to show consistency? No way. AS-25 has a very simple rule for this. Record it when earned. Income is recognized exactly when it actually occurs.
Now, let's talk about expenses. You can only defer an expense for interim reporting if it's also allowed on an annual basis. For instance, if you paid an insurance premium in advance, then sure, spread it over the quarters because the benefit comes in the future. But what if you suddenly spend a huge chunk of cash on a massive advertising campaign? You have to expense that immediately. You cannot defer it just to protect your quarter's profitability.
So, how is tax calculated? When the year isn't even over, how do you know what income bracket you fall into? Well, AS-25 says you have to apply an estimated annual tax rate to figure out your tax expense. Each quarter does not just apply a standalone tax rate based on its own individual profit.
Let's look at an example to really nail this down. If your initial estimated annual rate was 20%, then for quarter 1 and 2, a flat 20% tax is applied directly to the 200 crore income. But if mid-year your projections change and your new estimate jumps to 30%, then for the upcoming quarters, that new 30% rate applies to their respective income. Whatever your best annual estimate is, that's exactly what you follow in the interim.
Section 4, Estimates and Transparent Disclosures. It's all about maintaining transparency.
You see, interim reporting relies much more heavily on estimates because you simply don't have the hard data of a full year yet. Things like inventory valuation, provisions, and tax estimates all require a lot of judgment. Because of this, pinpoint accuracy might drop just a little bit, but your estimates must always remain reasonable and reliable so you don't mislead the market.
And because transparency is absolutely crucial, you have to provide mandatory disclosures in the explanatory notes. If there are any changes in accounting policies, major impacts from unusual items, or significant shifts in previous estimates, you have to state all of it clearly. The investor needs to get a crystal clear picture. Hiding behind the excuse of it just being an interim report won't fly.
So, Aarav followed AS-25 diligently, recorded everything accurately, and told his investors the absolute truth. The result? Investors really appreciated that detailed disclosure and trusted him. His stock price actually went up, because in the stock market, it's not just about current profit. Transparency matters just as much.
Section 5, Final Revision Blast. Let's hit those key exam targets.
Let's do a rapid-fire review. 1. Interim means a shorter part of the financial year. 2. The exact same accounting policies apply as the annual report. 3. You only defer expenses if it's allowed annually. Zero manipulation. 4. Seasonal income is recorded only when it's earned. 5. Always apply the estimated annual rate for taxes. And 6. Disclosures are absolutely mandatory.
If you want to keep mastering these high-stakes concepts through engaging stories, make sure to stick around. Because just like transparent reporting builds a strong market, solid concepts build a great career. Our next explainer on accounting standards is going to be even more powerful. Keep learning, keep growing, and I'll see you in the next one.